Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, we got some news and notes out of two major banks today, and that was Goldman Sachs and Morgan Stanley. So today we need to discuss what are the lessons we as investors can learn from this, and what changes, if any, do we need to make in our portfolios. And then lastly, what are they really talking about? What are they struggling with, if anything? And again, the most important lesson here is what can we use to inform our own investing strategy, and if there's anything that we need to be aware of. So this is really a tale of two banks, if you will, because one did terribly, the other did not so terribly. So I'll explain what I mean here in just a second. But for those that may not know, go ahead, hit the like and subscribe button. I really appreciate it. Aside from that, this is earnings season. Right now, we're primarily focused on financial companies, banks, pretty much. And those are always the first ones that announce every single year. If you're new, earnings is just when a company comes out and says, hey, here's what we did last year. Here's what we think is going to happen. We lost a lot of money. We made a lot of money. And the market reacts sometimes in a overly negative way and sometimes in an overly positive way. And the great thing about this, and what I love especially for new investors, is this gives us a time to do a deep dive into some of these companies, because when you start to get all these pieces together, it tells you a story of the stock market. It gives you a theme of what is going to happen or what could happen during the year. So notice we have Wells Fargo, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley. Once you start to pull all that stuff together, you say, okay, look, the financial industry is going through X, Y, and Z. This is the problem in that space. What could it mean for everything else in the market? Because they control the money, right? When they control the money, and if they're losing money because people aren't paying back their loans, that means a recession is around the corner. If they are not making as much money from their wealth management division or their investment banking division, that means that companies are not expanding. These are the companies, particularly Goldman Sachs and Morgan Stanley, when, let's say, Elon Musk needed, I think it was $19 billion or whatever he needed, he had to get that money from somewhere. He got it from Morgan Stanley. Okay. In other cases, you'll see that there aren't that many companies going public, doing IPOs. That means that their revenue is going to be down, which means that people are being a lot more cautious about what money they spend and whether or not they want to jump out into the stock market. So again, a lot of things that we can learn from earnings reports. Doesn't mean you have to invest or do anything, just a little information for us to pick up and start to piece together the story. So let's go ahead and jump through it. I got a few notes that really stood out to me for Goldman Sachs and Morgan Stanley. Now first, Goldman Sachs is down about 7% in the last 6 months, and then down about 0.8% over the last year, which is not terrible because it could certainly be worse. Morgan Stanley, on the other hand, remember, tale of two different banks. Morgan Stanley is up 25% in the last 6 months. Didn't see that coming. And they're up almost 6% in the last 6 months. They're definitely going in opposite directions. Morgan Stanley being in a positive direction and Goldman Sachs not so much. Now, Goldman Sachs definitely kind of sucked the air out of the room. The last 4 days, the stock market had been positive. We're on a bit of a winning streak. 2023 had been amazing for investors so far. Until today, Goldman Sachs came out and they tanked. Okay, what we did know was the headline is that their revenue dropped. I'm sorry, their net income, their profit in the fourth quarter dropped almost 70%. Almost 70% from Q3 to Q4 in 2022. Now they say, and this is evident in all their statements and all this kind of stuff, so they're not making it up. But what we do know is that, number one, they're not spending as much money with Goldman as what they used to for a lot of obvious reasons. We'll talk about those. They also set aside more than $900 million in terms of loan loss reserves. We talked about that before. What that means is when a bank, well, first off, most banks make their money from loans. If I say, look, I think the economy's bad, I'm not going to loan that money, I'm just going to hold on to it, that's less money that I can make money on when I loan that money. For example, I could loan you $5, you can pay me back $5, and I get $10 total. Well, if I hold that $5 in my pocket because I don't think you're going to pay me back, then I'm also not making money either. That is an issue, and that's one of the things that hurt Goldman Sachs. They also saw an increase in cost of 11%, which is also going to hurt your profit margin. On the other side, though, Morgan Stanley, what's the best way to say this? Morgan Stanley also lost money, which is the funny thing. Morgan Stanley was up today, whereas Goldman Sachs was down. Morgan Stanley has been up over the last few months and over the last year, and Goldman Sachs is not. The interesting thing here is Morgan Stanley also lost money. And if I'm not mistaken, I think they lost like 12% in revenue. Their profits are also down. And it's like, why are you down? Why are you also losing money, but your stock is up? It's all about expectations, which is stupid to me. But people expected Morgan Stanley to lose like 50%, and they lost like 40%. So they lost less than what was expected. That's why the stock is still doing well. The biggest thing here is this, or two things that actually stood out for me. Number one, you got to be careful. Okay, you got to be careful because when you are investing, sometimes you can say a specific industry, right? A lot of times I'll talk about the healthcare industry. Those are a ton of stocks that are doing well in that space. It does not mean that every single company in that space is doing well. A lot of these businesses are different based on who their clientele is. Morgan Stanley, they make a lot of money, not for me and you, because they don't really have a whole bunch of like checking accounts, a lot of mortgage accounts like a Wells Fargo might, right? Overdraft fees is really why Wells Fargo is still alive. And that is shade towards Wells Fargo. I said it, okay? Goldman Sachs, yes, they do have the smaller division of markets, but not really a consumer bank. They don't have a whole bunch of credit cards and stuff like that, like, I don't know, an Ally Bank does, or even a Citigroup to a lesser degree. So each of these banks makes money in different ways, which means they're susceptible to different risks, both good and bad. What else we noticed was this. Goldman Sachs came out and said they are going to continue to do this, which is lose money and not do all that great until they start to see changes in the Federal Reserve. We are not expecting to see changes from the Federal Reserve. They said last year that they are likely, or expectations were, that they were going to continue raising rates all through 2023 unless something traumatic happens or something dramatic happens. Either or is the only thing that's going to have them to change their stance. Inflation, at the last report, was like 7.1%. Their goal is to get it anywhere between 2 and 3. So we still have a ways to go. So what does that mean for you as an investor? Number one, until things change, I don't really think that financials are going to be one of the better places to invest. The other thing too here is that threat of recession is still out there. It is still out there. These banks are obviously concerned. $4 billion between the banks that reported on Friday, because Monday market was closed, and $900 million that they're saving at Goldman Sachs by themselves. So we're talking almost $6 billion that these banks are just holding on to in case people are not going to pay back those loans. That is going to be an issue. It is also telling us that because rates are higher, that anybody who is still relying on loans and are cash strapped, if you will, those that have to lay off people to survive, those companies are still going to be not the best places to invest so far. So keep an eye on that. We have a whole lot more news coming out next week and the week after because every company is going to come out and announce their earnings here pretty soon. And it's going to be a lot more to learn. The main thing is, and we've kind of said this before, and this is more evidence for that, what you saw in 2022 is likely to continue unless something changes. And that something changes right now sounds like it has to be interest rates, and inflation is coming down on its own. So that, I think that's kind of taking care of itself. But until the Fed does anything different about interest rates, it sounds like it's going to be a lot of the same, which means that go back to your 2022 playbook, look and see what stocks worked. What stocks worked, what strategies worked, and see if you can start to implement that in your portfolio if you have not already. All right, that is it for me today. If you want to learn more about what stocks worked, we cover this every single week inside of the members only. I did a trading walkthrough, how you can make money a bit faster if you're looking to it, as well as long-term strategies. We talk about it inside the members only every single week. You want to make sure that you can join that right here. It's on $10 a month. That's it. Okay? All right, that is it for me. I'll talk to you later. Bye.